Okay, welcome back to the deep dive. Today, we're circling back to a company you've asked us to revisit, Allianz Malaysia Berhad. But yeah, this isn't just a rerun, right? We're diving deep into their brand new first quarter 2025 report with fresh eyes and, well, the very latest numbers. You've armed us with your stack of sources. We've got the official Q1 2025 financial report, expert analysis from places like RHB, even some market commentary. And our mission, as always, is to cut through all that data, the insurance jargon, the corporate speak, to really pull out the absolute most important insights for you.
Exactly. And picking up where our last deep dive on their Q4 2024 results left off, this Q1 report is pretty crucial. It's like the first proper check-in on how they're kicking off the year. So we'll analyze their performance, apply our financial health scorecard, but based only on what this report tells us, and just see how the story's unfolding. Let's unpack this.
All right, sounds good. Let's hit the big picture first then. When we look at the consolidated results, for the entire group for this first quarter of 2025, what's the headline? What jumps out from the sources?
Well, the top line, the revenue, is looking strong. The group recorded an insurance revenue of RM 1.53 billion for the first 3 months of 2025. And that's a really solid increase, up 14.3% compared to the exact same period last year, Q1 2024.
14.3% year on year. Okay, that's significant growth.
It is. And if you look quarter on quarter, so comparing this Q1 2025 to the one just before it, Q4 2024, the sources show insurance revenue also increased. A bit smaller, but still positive, 1.7%.
Okay.
So they're not just growing year over year. They seem to be building momentum quarter on quarter as well, which is good to see.
Continued positive movement. That's the revenue side. What about the bottom line? Profitability. That's where the rubber meets the road, isn't it?
Absolutely. So profit before tax, PBT. For Q1 2025, it was RM 283.7 million. That's a nice jump too, up 13.0% from Q1 2024's RM 251.0 million.
Okay, 13% PBT growth year on year.
Yeah. And the sources largely put this down to higher profit contributions from both their main insurance segments, general and life.
Makes sense.
However, and this is a little bit of nuance, when you compare this Q1 2025 PBT to the quarter immediately before it, Q4 2024, there was actually a slight decrease, tiny, 0.3%.
Oh, okay. So down slightly from Q4.
Just a fraction.
Yeah.
So the story is really strong year-on-year growth, but maybe a very minor dip in that sequential momentum compared to the strong finish they had last year.
Got it. Okay, so that overall picture looks, well, pretty healthy on the surface, especially that year-on-year growth. But to really understand it, we need to look inside the engine room, right? The report breaks it down by segment. General insurance, life insurance, and then there's that smaller investment holding part.
Exactly. Yeah, let's start with general insurance. This segment had a particularly strong quarter, actually. Insurance revenue was RM 862.5 million. That matches the group's overall pace, up 14.3% year on year.
Same pace, okay.
And the report specifically points to growth coming mainly from increases in the money they earn from premiums in their motor and commercial business lines.
Motor and commercial driving the revenue. Makes sense. Those are big lines.
They are. Now, here's where it gets really interesting on the profitability side for general. Their PBT for Q1 2025 was RM 159.7 million, which is a jump of 20.7% compared to Q1 2024.
Wow. Okay, 20.7%. So profit grew faster than revenue in general.
Significantly faster. And the experts are pointing to higher net insurance results, so, core underwriting performance and investment results as the main driver. And what's fascinating here is when you look at the segment-specific ratios the report includes. The claims ratio, right, that's claims paid versus premiums earned, so lower is better.
Lower is better, yeah.
That actually improved. It decreased by 1.1 percentage points to 53.9%.
Okay, 53.9%. So better claims management relative to premiums.
Seems like it.
Yeah.
Suggests more efficiency there. Now, the expense ratio, that's operating costs against premiums. Yeah. That did increase slightly, up 1 percentage point to 25.1%.
A bit higher on costs then.
A little. But the big one, the combined ratio, which, adds claims and expenses together, a key measure of profitability just from the insurance business itself, that improved overall. It decreased by 1.2 percentage points down to 85.8%.
85.8. And anything below 100% is an underwriting profit, right?
Exactly. So 85.8% indicates, well, very healthy operational profitability in the general insurance business this quarter.
Wow. Okay, so that really explains that PBT jump in general insurance. Better claims efficiency seems to have more than offset the slight rise in expenses. How about the life insurance side then? How did that perform?
Right, life insurance. Well, they also saw revenue growth,
Hmm.
reached RN 666.2 million in Q1 2025. That's up 14.4% year on year, so almost exactly the same pace as general insurance on the top line.
Same revenue growth. Okay. Where did that come from?
The report says this was mainly due to higher insurance revenue coming from their investment-linked protection and savings products.
Investment linked, right?
Yeah. But profitability in life, it grew too, but at a much, much slower pace than revenue, or compared to the general segment's profit jump. PBT for life was RM 126.9 million. That's an increase of only 3.8% year on year.
Only 3.8%. That's quite a difference from general's 20-odd%. Why so much slower?
Well, the sources mentioned that while, yes, higher net insurance and investment results did contribute, this was apparently offset by lower other operating income, specifically from investment-linked protection and employee benefits business.
Ah, okay. So some other income lines drag it down a bit.
Exactly. It suggests factors outside that core premium and claim cycle had a sort of tempering effect on life profit growth this quarter, unlike in general where those factors seem to boost it.
Interesting difference.
And another point, when we look at a measure of new business written the annualized new premium, or ANP, the reports table actually shows a decrease of 9.1% compared to Q1 2024.
So less new business volume coming in.
Seems like it, based on that ANP figure. However, on the efficiency side, their expense ratio in life improved quite significantly. It decreased by 1.4 percentage points to 13.2%.
Okay, so less new business, maybe, but they managed costs better relative to the premiums they did have.
That seems to be the picture, yeah.
That's a fascinating contrast between the two main segments this quarter, then. Both growing revenue strongly, but general converting it to much faster profit growth looks like driven by underwriting efficiency. While life's profit growth was way more modest, possibly hit by those other income sources, even though they did improve expense management. What about the smaller investment holding segment? Any surprises there?
Not really.
Yeah.
The investment holding segment registered a loss before tax, as it often does. It was RM 2.9 million in Q1 2025. This is actually a slightly lower loss compared to the RM 3.6 million loss in Q1 2024.
A smaller loss. Okay. Why?
The report just notes it was due mainly to lower expenses within that specific segment. So still a loss, but yeah, slightly smaller. Yeah. So to quickly sum up the segments then, both core insurance businesses saw solid year-on-year revenue growth. General insurance was definitely the standout this quarter for profit growth, likely tied to that improved underwriting efficiency we saw in the ratios. Life insurance grew revenue strongly, but had much more modest profit growth, seemed impacted by factors outside its core premiums and claims, and the investment holding loss narrowed just a bit.
Okay, great summary. We've crunched the numbers. Now, in our last deep dive, we introduced that simplified financial scorecard approach, based purely on the info and the sources. How does Allianz Malaysia stack up on that scorecard based only on this specific Q1 2025 report excerpt and the analysis you have?
Right. Yeah, let's apply that framework, again, strictly based on what this quarterly report tells us. Here's how it looks. Okay, first, profitability. The report clearly shows strong growth in net profit and PBT year on year across the group and the segments. This indicates, healthy earnings power in this period. So we'd score this an 8 out of 10 based purely on those reported figures.
8 for profitability. Okay,
Yeah.
next.
Growth. That 14.3% increase in group insurance revenue year on year, growth in both main segments, and even that sequential increase from last quarter, it all shows really solid top-line momentum. So this earns a 9 out of 10 for growth, again, based just on those revenue figures presented.
9 for growth. Very strong. What about risk management?
Okay, risk management. The report does mention things like financial risk disclosures, how they classify investments, fair value stuff, and it notes an unqualified auditor's report for the previous full year, which are, positive indicators. However, this specific quarterly report provides pretty limited detailed information on the actual ongoing risk management framework and the processes being executed during this quarter.
So not much operational detail.
Not really, no. So based only on this excerpt, we have limited visibility into their detailed operational risk management. So this dimension gets a 5 out of 10. And that really reflects the lack of detail within this source. It's not necessarily a judgment on their actual risk practices, just what we can see here.
Okay, 5, reflecting limited info. Next up, valuation.
Valuation. This one's straightforward. The report excerpt we have contains absolutely zero information about market valuation. No share price, no market cap, No PE ratio, nothing like that.
Nothing at all.
Nope. So we simply cannot make any assessment of how the market values the company based on these results from this source alone. So this category gets a 1 out of 10 purely because the data just isn't there in this report to evaluate.
Right. Can't score what's not there. Okay, one left. Strategic alignment.
Strategic alignment. So the report states the group aims to continue adapting strategies for sustainable and profitable growth, responding to market changes, that kind of thing. And the strong Q1 financial results, particularly that robust revenue and profit growth year on year we talked about,
Right.
well, they align pretty well with this stated goal of achieving profitable growth.
So results match the stated goal.
Exactly. While a detailed strategic roadmap isn't laid out in this specific quarterly report, the results definitely support the high-level objective. So we'd rate strategic alignment as 7 out of 10 based on that reported performance matching their stated high-level aim.
Okay, so an 8 for profitability, 9 for growth, 5 for risk management due to limited detail, 1 for valuation due to no data, and 7 for strategic alignment. Putting those scores together.
Overall, based strictly on the information provided in this Q1 2025 report excerpt and the supplemental materials, Allianz Malaysia Berhad scores a 7 out of 10 on our simplified scorecard for this quarter.
7 out of 10.
Yeah. And this score is really strongly driven by that positive operational performance reported the clear strength in profitability and growth across both main insurance segments we saw in the financials. But the score is definitely pulled down significantly because this specific quarterly report excerpt just doesn't offer much detailed insight into their ongoing risk management processes, and it provides absolutely zero data points to assess market valuation. We just can't judge those from here.
Understood. That scorecard gives a concise snapshot based on the available data, highlighting strengths and limitations. Now let's talk dividends. This came up last time, especially since no final dividend was recommended for FY23. This Q1 2025 report gives us an update, right?
It does, yeah. If you look at the cash flow statement for the first 3 months, ending March 31st, 2025, it shows a pretty significant cash outflow. RM 262.1 million, labeled as dividends paid to owners of the company.
Okay, $262 million paid out in Q1. What was that for?
Right. The sources clarify this payment relates to dividends declared for the financial year 2024. It's likely the second interim dividend that was announced earlier. And interestingly, the cash flow in Q1 2024 showed the exact same amount, RM 262.1 million, paid out then too. That was likely for the FY 2023 second interim dividend.
Same amount paid in Q1 this year and last year for the prior year's interim dividend.
Okay. And crucially, the Q1 2025 report also includes the latest proposed dividend. This is a final dividend for the full year FY 2024. It's proposed at 63.0 cents per ordinary share and 75.6 cents per ICPS.
ICPS.
Yeah. Irredeemable convertible preference shares. It's just another class of shares they have.
Got it. So a final dividend proposed for last year, when would that be paid?
Well, it's scheduled for payment in July 2025, but importantly, it's still proposed.
Yeah.
It needs shareholder approval at the upcoming AGM.
Right. Needs the AGM nod. Okay, so cash went out in Q1 for an interim dividend related to FY24, and they proposed a final dividend for FY24 for payment later this year. Looking forward, though, does this report give us confidence in their ability to keep paying dividends sustainably? What do the sources say?
Well, the sources really highlight that for insurers, dividend sustainability is it's heavily influenced by a couple of big things: regulatory factors and, of course, the company's financial performance. Specifically, Bank Negara Malaysia, the central bank, requires written approval for any dividend declaration or payment. That's a major hurdle.
B&M has to sign off every time.
Every single time, yes. And a key part of that is maintaining sufficient capital adequacy ratio, or KR. You can think of KR as a measure of the insurer's financial strength, basically. Do they have enough capital buffer to withstand financial stress and, pay claims?
Right, their safety cushion. How's Allianz Malaysia doing on CAR?
The sources state they have consistently complied with KR requirements. In fact, they maintain a level in excess of the regulatory minimum, and this is supported by their own internal assessment processes.
Okay, so they have more capital than required.
Yeah, which suggests that, from a capital standpoint, based on what's reported here, they appear positioned to meet those regulatory requirements for dividend payments, assuming, of course, they get B&M approval each time.
Okay, capital looks okay. What else matters?
Well, the ability to pay dividends is also directly linked to how profitable they are. And if they have enough distributable reserves, basically retained earnings they're allowed to pay out. And the strong Q1 2025 profitability we discussed earlier, that certainly supports the potential for sustainable dividends going forward.
So profitability helps. Can we calculate, a payout ratio from this report? How much of their profit they're paying out?
It's actually tricky to calculate a precise dividend payout ratio, total dividends for a year versus that year's profit using only these sources. Like we see that Q1 2025 cash outflow for dividends, the RM2 62.1M, that's actually higher than the Q1 2025 profit of RM2 11.7M.
Oh, right. Paying out more than they earned in the quarter.
Well, yes, but remember that cash payment relates to last year's performance, not this quarter's profit. So it's not really the standard comparison you'd use for sustainability metrics.
Ah, okay. Comparing apples and oranges there.
Exactly. You'd ideally need the full year's total dividends and the full year's profit to get a clearer picture of the payout ratio.
Makes sense. And what about those past decisions, like not recommending a final dividend for FY 2023? Any insight on why that might happen?
Well, the sources don't give specific reasons for FY 2023 in these excerpts. But within that general framework for insurers, decisions not to pay a dividend, or maybe a smaller one, could be tied to needing to maintain those adequate capital levels for regulatory compliance, or perhaps retaining earnings for strategic reinvestment in the business. Or maybe there were other specific regulatory considerations at that particular time. It's complex.
Okay, so bottom line on dividends. They paid out cash in Q1 for last year's interim. They've proposed a final for last year. But future payments depend on B&M approval, keeping their capital buffer strong, which looks okay based on this report, overall profitability, and maybe strategic choices about reinvesting cash.
That sums it up pretty well, yeah.
Got it. Okay, moving beyond the raw numbers and dividends. What does this Q1 report tell us about where Allianz Malaysia is focusing its energy? What's their strategic direction based on these sources?
Right. The report does outline several key areas they're prioritizing for, future prospects, and driving profitable growth. Expanding distribution channels seems high on the list. They specifically mentioned focusing on agency transformation, recruiting more agents, improving agent productivity, and also retaining their best talent.
So focus on the agency force.
Yeah, seems like a big push there. They also explicitly say they aim to actively steer their portfolio towards a more profitable product mix.
Ah, so looking at what they sell, not just how much, trying to sell more profitable stuff.
Exactly. Suggests a focus on underwriting quality and profitability over just pure volume sometimes. And they also state they'll continue to adapt their strategy to market changes, strengthen their claims management processes.
Which seem to be paying off in the general segment this quarter, right? With that improved claims ratio.
Precisely. Good connection. And also enforcing disciplined expense management. They see these as key levers for profitability.
Okay. Distribution, product mix, claims, costs. Seems logical.
And this ties directly back to that idea we just discussed about potentially retaining earnings sometimes. It could well be for reinvestment into the business, funding these exact strategic initiatives, expanding distribution, improving digital capabilities, which they mention elsewhere, optimizing products, all to ensure profitable growth in what's still a competitive market.
Right, using profits to fund future growth initiatives. Makes strategic sense. Okay. Are there any specific legal or regulatory updates mentioned in the report that we should note? Anything significant?
Yes, there is an update on that ongoing case involving the Malaysia Competition Commission, MyCC, and their general insurance subsidiary. The report states the latest development is that MyCC's appeal against an earlier high court decision in the case. Well, it's now fixed for case management on May 29, 2025.
Case management, what does that mean?
Basically just a procedural step to set a new hearing date for the actual appeal.
Ah, okay. So that legal process is still ongoing.
Still ongoing, yeah. And it's noted in the report as an ongoing contingent liability, something that could potentially cost them money down the line.
Right.
But the outcome is uncertain.
Got it. Contingent liability. And what about external challenges? Are there risks or headwinds they're highlighting or that the analysts are pointing to?
Yeah, the experts in the reports do highlight some ongoing challenges, particularly for the life insurance industry in Malaysia. These include things like persistent regulatory pressure and also sentiment pressure, whatever that entails exactly. And there's the really significant issue of rising medical inflation in Malaysia, costs for healthcare going up.
Yeah, that's a big one everywhere, it seems.
It is, and Bank Negara in Malaysia has brought in some interim measures. One source notes these require insurers to spread out any premium increases for medical policies over at least 3 years.
Okay, so they can't just hike medical premiums all at once to cover rising costs. They have to phase it in.
Exactly, which obviously impacts how quickly insurers can respond financially to that rising cost of medical claims. It puts pressure on margins.
Right, that sounds like a significant challenge. Anything else?
Other potential headwinds mentioned include market uncertainty impacting investment income. We saw a hint of this, actually, in the Q1 results themselves. Analysts noted some mark-to-market losses on their domestic equity investments during the quarter.
So stock market movements affecting their bottom line.
Can definitely happen, yeah. And then there's just the general competitive landscape in the Malaysian insurance market, which, remains pretty intense. Lots of players fighting for business.
Okay, so they've got these clear strategic goals: distribution, product mix, efficiency, but they are definitely operating in a dynamic environment. Regulatory changes like the medical premium phasing, cost pressures from inflation, market volatility hitting investments, and tough competition. Lots to navigate.
Absolutely. It's not smooth sailing, even with good results this quarter.
Right. Now, in our last deep dive, we briefly touched on this concept of an economic moat. That sustainable competitive advantage that helps a company defend its market position and profitability over the long term. Does this Q1 report offer any new insights into their potential moat? Are they building one, strengthening one?
Well, the sources note that the term economic moat isn't actually used explicitly in this specific Q1 2025 report or the provided excerpts. They don't talk in those terms directly.
Okay, they don't use the label, but what about the substance?
Right. The sources do reiterate elements we've discussed previously that could contribute to a moat. Things like the strong Allianz brand identity, its established market position as a leading provider in Malaysia. It's certainly an advantage. Also, the sheer scale of their operations can create efficiencies. And the significant regulatory hurdles for new entrants, it's hard for small competitors to just pop up and challenge them quickly.
Brand, scale, regulatory barriers. Those sound like potential moat sources.
They are. And their investments in areas like digital capabilities, which align with their strategic focus on distribution, could also strengthen their position. But the sources kind of conclude that this particular Q1 report, because it's focused primarily on quarterly financials and just high-level prospects, it doesn't really provide a detailed roadmap or, crucially, quantifiable targets that would allow us to definitively assess the nature or the strength of their economic moat over, say, the next 5 years.
So no clear moat-building plan laid out here.
Not really. The strategic focus areas mentioned distribution, product mix, efficiency. They're important for maintaining growth and position, absolutely. But they come across more as broad initiatives needed to compete effectively, rather than specific, durable competitive advantages being highlighted as actively built or leveraged in a way that would create a really strong long-term moat. If that makes sense.
Yeah, that makes sense. It's more about running the business well in the current environment than explicitly building unbreachable defenses for the long term, at least based on this report.
Yep.
Exactly. A quarterly report gives us that performance snapshot and the near-term focus, but maybe less detail on the long-term competitive structure they're aiming for.
Right. Wow. Okay, that was a truly thorough deep dive into Allianz Malaysia Berhad's first quarter 2025. We saw, robust revenue and profit growth overall year on year, driven by both insurance segments. But with that really interesting nuance in profitability growth between general and life when we looked closer, general really powered ahead there.
We did. And we applied our financial scorecard based strictly on the report, highlighting those strong areas like profitability and growth, while also being clear about the limitations, especially on assessing risk management detail and valuation, just from this specific source alone. We followed up on the dividend situation, too, saw the cash payout in Q1, the proposed final dividend for FY24, but also got a better understanding of that complex interplay of regulatory approval, capital levels, and profitability that really influence those dividend decisions for insurers. Definitely. And we explored their stated strategic priorities for continued profitable growth, especially around distribution and optimizing their product mix, and acknowledged those external challenges they face, from regulatory changes like those impacting medical premiums to market competition and investment volatility. It's a tricky environment.
Absolutely. And pulling all these threads together from the financial report, the expert analysis, the news coverage, it really gives you, the listener, a much richer, more connected picture than just looking at a single headline number. It shows how performance metrics, strategic intent, and all those external factors kind of weave together for a large company like this.
It really does. And, as always, after a deep dive like this, new questions always seem to emerge. It pushes the thinking forward.
Precisely. I mean, we've seen Allianz Malaysia outline its strategic focus areas like expanding distribution, optimizing their product mix, sharpening cost, and claims management, all aimed at driving profitable growth in what is clearly a challenging market environment. So this leads to, I think, a key question for you to consider as you watch their progress going forward. Given those persistent regulatory and market pressures in the Malaysian insurance industry, particularly around rising medical costs, evolving regulations, investment volatility, how effectively can Allianz Malaysia's stated strategic execution truly safeguard and enhance its profitability and its competitive edge over, say, the coming year or two? Can the strategy overcome the headwinds?
That's a great question. Something to definitely mull over as you follow their next steps in future reports. Thank you for bringing all your sources and insights to the deep dive today. We really hope this exploration gives you valuable insights for your own understanding. Stay curious, keep digging, and join us next time for another deep dive.